Today I would like to analyze Diageo, one of the largest alcoholic beverage companies in the world. We can see here the stock price is down around 53%, so we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is the market cap of 54.98 billion US dollar. This makes Diageo the fourth largest alcoholic beverage company in the world by the market cap. We also have a dividend yield of around 4.34%, which we can see here did grow in a decent rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2021, the revenue was around 17.59 billion US dollar. We had a very good growth around 20% from 2020. In 2022, we had a good growth again around 16%. In 2023, we had a bad growth around 0.19%. And then in 2024, we had a decline around 1.39%. So this is something we don't like to see. But overall, in the last 5 years, I think we had a decent revenue growth. So still be a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2021, we had a free cash flow of around 4.18 billion US dollar. This was an incredible growth, around 108% from 2020, so probably related to COVID. Then in 2022, we had a decline around 10%. This is something we don't like to see. Then again, 2023, a strong decline around 40%. And then in 2024, we had a decent recovery with a growth around 16%. So overall, in the last 5 years, we had a free cash flow decline. So it's not a check here, and we don't like to see that. The next thing we're looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 2.6 billion. We're going to divide it with the current market cap, 54.98 billion. And then we're going to get the free cash flow yield that we're looking for. This is around 4.72%. And I think it's a decent free cash flow yield, as over the 4% that we're looking for. So the check here. We can also take a look at the future assumptions of the free cash flow. In 2025, around 2.75 billion. In 2026, around 3 billion. In 2027, around 3.5 billion. So let's assume for 2027, 3.5 billion. We're going to divide it with the current market cap, 54.98 billion. And then we're going to get the free cash flow yield for 2027 with our free cash flow assumptions. This would be around 6.36%. And I think it's a good free cash flow yield for 2027. So it would also be a check here, and we like to see that. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. A very important number, because if the company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt, 18.98 billion. Then we're going to add the short-term debt as well. So the short-term debt is here around, actually close to 2.9 billion. So then we're going to divide it with the current free cash flow, 2.6 billion. And then we're going to get the ratio that we're looking for. So the number we're going to get, 8.41. And this number is not very good. It means over 8 years we're going to take to repay the debt with a free cash flow right now. So it's not a check here, and we don't like to see that. But we can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 1.41 billion. I think it's a decent amount. So overall, I think this company doesn't have a very good balance sheet right now. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. This can also tell us about the valuation of this company. The lower the number gets, the higher the indication for the undervaluation. So first we're going to calculate the enterprise valuation, the current market cap, 54.98 billion. We're going to add the debt, 21.88 billion. We're going to take minus the cash, 1.41 billion. And then we're going to get the enterprise valuation, so how much the whole company is worth. And this is around 75.45 billion. So now we're going to divide this number with the current free cash flow, 2.6 billion. And then we're going to get the ratio that we're looking for. This is around 29.01. And this number is not very good. This could be already an indication for overvaluation because we want to see this ratio under 25. It's not a check here. We can also calculate this number for 2027 with the free cash flow assumptions of 3.5 billion. Then we're going to get a different number. The number we're going to get would be around 21.55. And this is a decent number. It would be under the 25 that we're looking for. But overall, I think this company doesn't look really undervalued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that especially we think the company is undervalued. So we can see here repurchase of common stocks. Yes, this company buys back their own shares, especially in 2022, nearly $3 billion US. So it's a check here. But it's not something really positive actually for this company because they have a huge amount of debt, and I think this can also risk the company financially in the future. Can the Diageo stock be a good buy right now? The stock price is down around 56% in the last 5 years. So let's start with a positive about this company. I think they had a good free cash flow yield of around 4.72%. In 2027, our free cash flow assumption, it could be around 6.36%. So now let's go to the negative. I think the revenue growth was just decent in the last 5 years. I also think they had a bad free cash flow growth as well. This is something we don't really like to see. The balance sheet is also looking bad. They have a huge amount of debt. Then the enterprise valuation to free cash flow ratio around 29 is also not very good. We like to see that number under 25. In 2027, it could be around 21.55. So this would be a decent number. But overall, I still think this company is overvalued because they're not growing much. The financials is not looking very good. The dividend yield of around 4.34% is quite interesting. But overall, I think this company has too much risk and is not very good to invest in right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.